All right, and welcome.
Hello.
Welcome, Michael. Welcome, Trip. Just as we did with the first panel, we're gonna start with some quick introductions. Kind of describe a little bit about yourself, your background in the DC space. So I'll start off with Michael.
Hi, everyone. My name is Michael O'Connor. I'm Managing Director with Clarion Partners, and I spearhead our defined contribution real estate strategies here. I also serve as co-president for the Defined Contribution Real Estate Council, which I'll mention. The organization has been in existence for about 9 years, and the goal is really to bring together leaders in the both real estate and the DC market to improve outcomes for DC plan participants through the inclusion of real estate. And many of the folks on the call today are members of the DC REC.
And Trip. And if you are, I'm going to warn you, you are muted.
Oh, let's try it again. Thanks, Loretta. Thanks, IREI, for putting this together. This is great. I know some of the folks on this webinar today are probably just hearing about DC for the first time, but to Michael's point, this is something that a lot of us think about almost every day. We're members of DC REC as well, which is a great group to bring sort of like-minded managers together and talk about some of these issues. So I head up our DC channel at Heitman. I joined the firm a couple of years ago, and I've had the privilege of working with plan sponsors and consultants and record keepers in the DC business over the past 20 years. So while I'm new to real estate, relatively speaking, I'm sort of a veteran in DC. I joined Heitman because I saw a huge potential in delivering our real estate solutions to DC plans. Just like the panel before us talked about, I think there's a huge opportunity here. We'll explore that on our panel, and I'm sure the final panel as well. Heitman's been doing managing real estate for 55 years for institutions. Like DC plans, so globally, DB plans, sovereign wealth, et cetera, we run about 46 billion in total assets. So looking forward to the conversation today.
And I think I want to start things off. Both of you were following along to the previous panel. Do you have any reactions or comments regarding what you've seen so far? I'll start with you, Michael, and then I'll go to Trip.
Well, it's a pretty robust conversation. I think hopefully the takeaway for many of the folks listening, and including myself, is right, the DC market is constantly evolving. And for real estate managers that are thinking of entering the space with a product, there really isn't a silver bullet, a single strategy that works for the entire DC market. It's comprised of many different segments. And so having different types of strategies, product structures, and testing different segments and seeing what works for each segment is really the name of the game. And for plan sponsors, it's the same. They have to think about what works best for their own employee base. And it may not be one type of vehicle or one type of manager strategy. It may be putting together different vehicles and strategies together for their own participants, which again, quite vary.
And Trip?
Yeah, I thought the panel was excellent. I mean, I'm looking at my notes from that I kind of jotted down here. Great topics, talked about fiduciary, multi-asset, sectors, so DB versus DC. So great job on that panel. One of the things that stuck out for me was really, I think one of Allison's question to the panel, which was, why would you add private assets or private real estate to a DC plan now? I mean, equity markets are great. Everybody's happy. I would sort of flip that around and think about it from really two perspectives. The first perspective is from an investment perspective. So I would say that, the equity market, we haven't seen a correction for 18 months. It's pretty much gone straight up. We're probably due for some type of correction, globally in the near term. Equities may be overvalued. And then when you look at bonds, it doesn't seem like a great alternative either, right? You see inflation sort of, coming up. We're not sure if it's going to be permanent or transitory, but we're starting from such a low base in terms of rates that, bonds just don't offer a great value either. So where do investors go to mitigate these risks? And if I go back to Sean's comment about the 5 things that private real estate does, I mean, if I were to tell you, okay, I can offer you a solution that gives you growth, inflation protection, income, low volatility, and essentially offering ballast for your portfolio, would you add that to your portfolio? And I think most investors would say, of course I would.
Sign me up.
That's great. I mean, I'm all in. So, you know, and that is private real estate, right? So I think there is definitely a role from an investment perspective. It makes a ton of sense, you know, for just generally, you know, a multi-asset portfolio. But I also think about it from the participant perspective as well, you know, and I think about, you know, participants, the last thing that we want as sort of practitioners in the DC business is for participants to open their statement and have the moment where they just freak out because they see their balances decrease dramatically, right? That's the last thing that we want. So we really want to smooth out that ride, right, for participants, and lower volatility. So I think that's the one sort of, you know, place that real estate probably adds the most value is by lowering volatility. But, you know, the other thing about real estate from just a participant perspective is that, you know, it can help both on the accumulation phase, right? So when you're working and you're adding, you know, contributions to your target date funds, but also on the decumulation side, right? So when you're actually drawing assets from your DC program in terms of income. So it really, you know, real estate's one of those things that kind of fits everywhere, right? You know, whether it's listed or private.
And Michael, I want to give you the chance to also elaborate a little bit on, you know, why would you put real estate in a defined contribution plan? Tripp's had a bit to say, but maybe you have some thoughts too.
Well, look, you know, it's interesting when you think about the evolution of the DC marketplace. For a period of time, there was really a run towards just doing passive strategies and as low cost as possible. Okay? And over the last several years, we have been finding that plan sponsors and the consultants and the fiduciaries that are assisting plan sponsors are trying to look at how can active strategies be used with passive strategies to actually improve both returns and lower that volatility. It's not just a race to the bottom. It's not just a race to everything that you just watch the indexes. You need to put both together in a DC plan to really optimize the outcomes that Tripp is highlighted here. And so that's where private real estate, because it's actually better as an active strategy to solve all of those different elements of whether it's inflation hedging or income and alpha return is coming from active management of private real estate to add to the DC plan.
Yeah. You know, so a couple of things I'm hoping that we can do on this panel is talk about some of the trends that are happening in the market, so some of the things that are happening, and then maybe talk about some of the challenges that have sort of posed a bit of a roadblock to the adoption of private real estate, and then how those might be addressed or mitigated. So that's just sort of an overview for the audience of what we'll be talking about right now. So starting things off, you know, which approaches to including private real estate in DC plans are gaining traction? You know, what do you see? You know, we talked a lot about the evolution. What trends and approaches are happening right now? And I'll start with Michael and then I'll go to Tripp.
Well, the prior panel actually touched upon 2 of the vehicles that are most used for trying to bring private real estate to the space. One is called a collective investment trust, and the other is an insurance separate account or an annuity type structure. Both have been successful over the last decade of actually becoming a means of accessing existing institutional strategies, ones that are already being used primarily by defined benefit plans. They have a track record. They have an identified asset base, so you're not greenfielding, so to speak, into the real estate investment. But they act as an entry point that can then plug in well with the DC plan. They can provide daily valuation. They can provide a risk plan reporting that's required. And importantly, and something that's kind of missed by a lot of folks that don't traffic in DC world, there is an important element between a player, if you will, that exists between DC plans and their participants. And that's the role of what's called a record keeper. They are essentially the plumbing that connects the investment strategies to what an employee views on their statement, and being able to track their investments on any given day and move in and out of that. And for many years, record keepers have not been familiar with these private real estate vehicles, but increasingly they have been. And so as time goes on and more plan sponsors add them to their plan, and record keepers, again, that important plumbing, becomes familiar with the processes for daily valuation and liquidity, we will find that more and more folks will then have access to these strategies.
A Trip? You wanna weigh
Yeah,
in here?
and yeah, just to add to what Michael's saying, just about, kind of vehicles, and we've opted for the collective investment trust vehicle, and it is highly efficient in the defined contribution market. Actually, most of the assets in the DC, of that $7 trillion of DC assets, are in collective investment trusts versus mutual funds. They act and smell and look just like mutual funds, traded every day, super easy for record keepers to use. So one of the great things I think that we can do with these vehicles is sort of democratize investing, right? Where a participant who doesn't have a ton of money and a DC plan can access potentially a private real estate strategy that in the past was really only available to the largest institutions in the world, right? So to me, that's a great situation, right, for the underlying participant. But then when I think about approaches to, I think about some of the ways that private real estate can end up in a DC plan. The previous panel talked about target date funds. But there's a couple other ways as well that we're seeing some uptake. One is what we would call white labeled funds. And these are funds that are like specific purpose funds, right? So think about, a large cap equity fund or a fixed income fund, or in our case, like a real assets fund where you could put private real estate in like an inflation protection type strategy. And it really simplifies things for the underlying participants. And then the last point I'll make here is just around, DC plans really hiring a professional manager to create and maintain their multi-asset solutions like custom target date funds or white label funds. And some folks on the webinar may have heard of OCIO, or outsourced chief investment officer programs, where consultants really sort of take the reins and become the full fiduciary. And make all investment decisions, as it relates to, a multi-asset strategy inside a DC plan. And to me, when I think about that, it looks a lot like a DB plan, right? I mean, you're almost replicating what happens on the DB side. So I think, we're definitely coming together, right? DC plans and DB plans are sort of coming together and looking a lot more similar than different.
Yeah, and my understanding, and Michael, I think you were going to weigh in. Historically, the DB plan, the people who administered a DB plan for a company and the people who administered a DC plan for the company existed in completely different spheres. They never spoke, they never interacted, they had no conversation. Is that changing? And maybe I'll start with you, Michael, and then go back to.
Very, very much so. And we are seeing a trend not only on the private corporate side of plans, but also interestingly on the public side as well, where those folks that have been dealing as real estate specialists primarily on the defined benefit plans are now trying to port some of those strategies, some of those managers, some of those very efficient arrangements, because they've obviously had some very, they've come to fee arrangements with their defined benefit managers. They're trying to port those over to the DC side and get the benefit of scale and knowledge on that side as well. And we are seeing those coming together. And in the same token, many of the strategies that we were talking about, either whether it's a CIT or an insurance company vehicle that are being focused on target date funds or white label funds, they're actually accessing Odyssey funds or the core index and bringing them into the DC space. And that's, again, in the DC REC, as we've done research on this, we have noted that when the NCREIF daily price index started in 2015, it started with just 3 managers that had a daily valued product. And now today that in the index itself is 11 managers, and the stat that was used in the prior panel, it's about $50 billion of AUM. But beyond that, there are additional daily priced vehicles that are not included in the index, and that's more than 20, right? When you add it all up, different strategies, different liquidity. So there are a lot of options, and many of these are the Odyssey core institutional funds being brought from the DB space and being available to the DC plan sponsors as well, right? Really broadening the investor set.
Mm-hmm. With that, I just want to remind the audience that, you can ask questions by clicking on the Q&A button, and I will be posing those questions as we come in. I want to talk a little bit, as I said at the beginning, I want to talk a little bit about some of the challenges, though, because if you watch the first panel, the potential size of real estate investment by DC plans, if it mimicked a 10% allocation, massive. The actual investment right now is not yet massive. What are some of the things holding that back? I'm going to start with Michael, and then I'll go to Tripp.
Well, again, the prior panel touched upon some of the big ones, right? So there's been concern about fees. There's been concern about potential litigation for including private market assets in a DC plan. And some folks have also equated the public markets in terms of public real estate and private real estate, with the view that, hey, I can just get my real estate proxy using publicly traded REITs and not using private real estate. Those are some of the most prominent ones. And then I also touched upon the plumbing itself, right? Those folks that are actually delivering it, being familiar with how do we make sense of this private real estate in a DC context, right? So I would say those are the 4 most prominent roadblocks that have existed.
Tripp, would you say that as well? Do you have any additional roadblocks you'd point out?
Yeah, for sure. Just to add on to the fee, roadblock, I think, I think the fee issue is starting to wane. I think it's largely behind us. I think in the past, a lot of plan sponsors and their consultants were looking at just compressing fees across the board, right? So how can we wipe out, or lower fees for the total DC plan? The obvious, easiest, and first placed that folks looked was with asset management, going to passive. But now, I think plan sponsors and consultants are being more thoughtful, to be honest about it. And I think, they're looking at fees from a holistic standpoint and creating a holistic fee budget. And I think this goes back to Michael's point, around passive and active, right? And using sort of, passive where it saves and active where it pays, right? Where it matters. In efficient markets, you're using passive, and then inefficient markets like real estate, using active, and sort of allocating your fee budget accordingly, right? And agreeing with, your consultant on where that fee budget is, and then managing to that. So I think that's encouraging, certainly for us as sort of active managers. The other thing I would say, is just COVID. We got to talk about that on this panel, right? It wouldn't be normal without that. So I think the pandemic, has definitely, it created challenges for sure. I think plan sponsors were sort of in, a highly reactionary mode over the past 18 months, trying to solve for really pressing issues and priorities that were, plan participant directed, like, okay, how do I make sure my participants have an emergency savings vehicle, maybe a sidecar attached to the DC plan, COVID, withdrawals, that sort of thing. But I think that's largely behind us. And I think, plan sponsors are now looking forward towards, okay, what's the next thing that I can do? And thinking about participants, right? Like participant outcomes. How can I enhance my participant outcomes moving forward? So I think we're going to see new innovation in the future.
Yeah, and let's dig on some of those challenges and maybe address some of the mitigations. Trip touched a little bit on fees, but Michael, do you have more to say on, how the market might mitigate the fee question? How are we moving past it toward a more active approach again? Is that
Well,
something?
yeah, certainly, Loretta. I wholeheartedly agree with Tripp in terms of that the trend that we have been seeing among those folks that have a target date fund or a thematic white label fund is that they are using both types of strategies increasingly, those that are passive and tend to be lower cost, and those that are active, like private real estate, in putting the two together to keep fees efficient for their employees, but not going all in one way or the other. The other thing that we have found is that really the first movers for those folks that are using private real estate in their DC plans are in a couple of buckets, right? One is this hybrid target date fund environment. The second are those plan sponsors that have dual plans. They have a DB plan historically that, as Jeff mentioned at the top of the session, have been frozen, and now they have a DC plan for their employees. And by porting these strategies over and getting economies of scale on both sides, they're actually also able to offer efficient fee regimes because they're using the assets of both sides to negotiate a good price that's fair for all sides, right? So that's one thing that we've been finding that's addressing some of these hurdles as well. And then I would say the other trend is also this rise of OCIO activity in the space, and many of the OCIO folks, like Allison's company Mercer, they are already familiar with the benefit of alternatives, and by educating the ultimate consumer here, which is the plan sponsor, first and foremost, because they are the ones who are the shepherding their own plan on the benefits of private real estate, that can get them over some of these concerns and these hurdles.
Now, one of the other issues that's been brought up as a hurdle is litigation. And I actually have a question from the audience that kind of builds out on that question. They talk about law firms that have won DC lawsuits when arguing about basis points. The expenses on real estate are very high relative to other investments. Will the managers assume this liability? And I think he's asking, will you assume a liability around litigation? Is that how managers are mitigating this issue, or are there other approaches? Trip.
That's a good question, and it's it's definitely been a top concern for the industry for a while, right? I don't think that the managers would, we are fiduciary to the plan, along with the plan sponsor and the consultant. So anybody that's sort of working on the plan is a fiduciary. But I think, kind of going back to my original point around, setting an intentional fee budget, right? And having a process, right? So if a plan sponsor and a consultant and their managers can sort of show a process around, okay, why did we select these managers? What was our process around that? Most of the time, the courts look at that and say, there was a process that was followed. There was a fee budget that was set. And the plan sponsor and the consultant acted prudently, right? So, we're definitely seeing more and more of these cases kind of get thrown out, right? The low hanging fruit has been sort of picked off. Like, there were plans that truthfully were too expensive, right? That had, their participants in the wrong share class, maybe a mutual fund like an A share class where there was a cheaper share class available. But I think what we're talking about here are, we're not talking about any revenue sharing. I mean, we're offering the cheapest share, sort of investment management platforms available to plan sponsors.
Michael?
I agree with, Tripp is dead on. It really comes down to the process, right? When the Department of Labor, which is the regulatory authority that oversees all DC plans, has noted repeatedly, and it's not just real estate, it's that fees in themselves, a higher fee product, or is not in itself something that is anti-participant, is illegal in nature or a liability in nature. It is the process by which plan sponsors evaluate investment options that they make available to their participants. And just before the pandemic, the Department of Labor actually came out with a guidance letter for plan sponsors in the community that talked about the process by which plan sponsors could incorporate private equity, private markets investments in their plan and still meet their fiduciary obligations, right? It's a process-oriented thing rather than high fee, low fee.
Right.
I'm glad you brought that up, Michael.
And it looks like he might have frozen just for a second, but I want to
all of a sudden you have.
And now I want to take in turn the third challenge that we're facing. I think you talked about conflating public and private real estate as equal, and I think one of the comments in the previous panel was that they should be thought of as complementary, not sort of interchangeable. What's your thoughts on public versus private real estate, REITs versus investing in private real estate? And is that a challenge that the market sees them as the same? I'll start with Michael.
Well, let's think about the asset class in itself, right? So commercial real estate, for many laymen, they don't realize that it's a pretty sizable asset class. It's $11 trillion of investable assets. And when you look at the institutional defined benefit plan history of investing in real estate in general, they have typically focused on that, incorporating commercial real estate. But interestingly enough, the ratio of incorporating commercial real estate actually is very similar to what the private versus public in overall for the sector. So about 90% of all commercial real estate is privately held versus publicly held. And in most DB plans, that ratio is about what they have. If they're allocating 5, 10, 15% in real estate, typically the majority of it is in private real estate. But they will still use public, and they use them complementary. And many of the daily valued products that have been brought to the DC market actually include both private and public together. Primarily, the public is acting as more of a liquidity element, but they are putting them together in the same vehicle, and they do provide a complementary diversification in lowering the volatility and ultimately increasing the Sharpe ratio or the returns for that plan. So we have, at least as a real estate manager, we have talked about the benefits of private real estate, and it was covered by the prior panel. But really, the petri dish is what just happened during the pandemic last year, right? And Tripp highlighted it. If someone was just investing in public real estate, then they took a roller coaster ride during the second quarter of 2020, and that dampening effect of having an exposure to private was well shown last year, which is why I think actually a number of us that have DC real estate strategies are finding increased interest from DC plans of bringing it in, because you actually have a very recent example of where private real estate can help diversify your portfolio.
Yeah, Tripp, you want to weigh in here?
Yeah, sure. Michael and I are on exactly the same page. We at Heitman believe that private and public real estate are complementary as well. In our fund, our CIT fund, we have both. It's mainly private, but we have about 15% in public real estate securities to serve as sort of a buffer, a liquidity buffer. But it also, enhances the risk return profile of the total portfolio. So yeah, we're big advocates of sort of the complementary nature of both private and public. The other thing I'd say too is, most of the large Odyssey funds out there invest in sort of the top, 4 sectors of the U.S. commercial real estate market, the largest sectors. But we're seeing what we call specialty sectors sort of become more and more prominent and important today. Things like medical office buildings, data centers, towers, those type of sectors aren't really there's a little bit, but not overly included in Odyssey. So, you can get exposure to those sectors using listed securities, and sort of add that to a private portfolio. We're actually seeing interest on the DB side, in that area. So DB plans that want to sort of, complement their existing Odyssey, exposure. And I think maybe that's a little new for DC. Maybe down the road, DC may get there, but, it's just, they're very, very complementary. So.
Yeah, certainly something that we've been tracking here at IREI is noticing that if you look at, sort of the REITs, the REIT public REIT market, it is at least 50% by market cap, what we would consider non-traditional or specialty or alternative property types. Whereas, yes, the NCREIF Odyssey is still very much largely focused on, sort of the traditional four main property types. And so, yeah, I think there is really something to be discussed there as we talk as an industry. Mm-hmm. One question I want to touch on, but before this is all over, because I really want to talk about this, I want to talk about some of the implications of the Secure Act. I understand that creates a pooled employer plans, and what might that mean for the inclusion of private real estate in defined contribution plans? And I want to start with Michael on this.
Well, look, this was a monumental change, really, when you think about the passage of the Secure Act and having this particular provision. For those folks that aren't familiar with it, think of it very similarly as what was discussed on the prior panel is the Aussie super plans, and it's having a sophisticated manager, a fiduciary, whereby a plan sponsor can then engage that fiduciary to manage the plan for them, and they can pool together companies that are not the same, are not unalike. Historically, law firms and other similar employers could do so under multi-employer plans, but by now being able to band together unaffiliated plans, multi-company plans, there's benefits all around. Employees and participants can get the benefit of scale by having just lower cost to operate the plan in general. You can also get the more sophisticated management, which is something that we talked about earlier, right? Rather than just providing this supermarket of options, as you highlighted, Loretta, to employees to pick off a lineup and choose which funds that they want every day. You're taking now like a target date fund concept and turbocharging it, because now you are able to employ folks, professional managers that can really manage a multi-asset portfolio for the benefit of participants, and participants can say, I want one of those. And where we think this might also go is it can provide another solution down the line, which is portability. Right. One of the issues in today's world, there's a number of younger employees that they don't stick around at a company for 10 or 15 or 20 years anymore. They're leaving every few years and maybe going for new opportunities somewhere else. And then to have to roll their money out to an IRA or start another plan somewhere else, they have all these different retirement plans in different places. And it I'm sure is confusing to them, and it makes them not want to participate in a DC plan if that's the case. But if we move to PEPs or pooled employer plans, that could conceivably solve portability. If there's a few large ones that people can just take with them when they go to a new company, it's a win-win all around.
Yeah, Trip, I see you nodding along. You're agreeing with Michael?
Totally. I mean, absolutely. And I think, to Michael's point, I think the biggest benefit's going to be seen, in small and mid-sized companies, right? The companies that don't have scale, the companies that sort of, offer a DC plan because, they kind of have to, and put together just that menu of mutual funds, right? That participants are kind of almost lost in trying to figure out what to pick from. So I think the biggest thing for me, though, is one thing Michael said just around professional management and OCIO providers sort of, managing these plans, right? So if you think about it, it's going to dramatically enhance the participant experience, right? you're going from a situation where you're just picking some funds and hoping you do the right thing, and picking the right strategies for retirement, to, selecting professionally managed, what I would call outcome-oriented strategies. So a professional custom target date fund that is thoughtful and includes all the arrows in the quiver of an OCIO provider that, has in managing true institutional assets, right? But then I think just simplification, I think, is a huge enhancement just for most DC plans. I mean, if we think about, some of the inequity that COVID created, a lot of that inequity is really in retirement savings, right? And folks that just don't understand their DC plan and don't want to get take the time to learn about it are just not going to participate, right? But if you can create really simple and elegant solutions that say, look, you can go into this fund that's a do it for me fund. We're going to manage it for you. Oh, and oh, by the way, if you want to do it yourself, here are like 3 other options: a US equity fund, a global equity fund, and a fixed income fund. It makes it pretty compelling, right, for folks to get involved and to participate. So I see, plan sponsors really being concerned with that and making sure that all their participants are engaged. Large plans are already doing it, right? Mega plans are already doing it, but small and mid-sized plans don't have the resources, and they're going to join these MEPs and PEPs that are going to do it for them, essentially.
Yeah, and I think that's something that you talk about, the sort of the idea of retirement equity, and I think that's really important here for us to talk about, because when it was first launched, the 401k was thought of as really sort of a supplemental, sort of tax advantaged side product. Well, now it's kind of become the main event. What does that mean for making sure that people will be able to retire? And how do you kind of see that?
Yeah,
real estate has a role to play here.
I think we've done in sort of in my 20 years in DC, definitely over the past 10 years, I think we've done a much better job as an industry to sort of reposition DC as the primary retirement, sort of savings vehicle. I mean, just little things like, instead of showing a participant like their total balance on their statement, a lot of record keepers today are transitioning that into a monthly income number or a projected monthly income number at retirement, right? So that's much more meaningful to a participant than a total balance, right? I mean, and sometimes if it's the total balance is too low, you get discouraged, or if it's too high, you get sort of disengaged, right? But I know what my monthly sort of income number I need to live on today and probably in retirement. And I can see, am I on track to meet that or not, right? And really simplifying things. So yeah, and we can talk about innovation and so forth. And I think we've done a lot of those things. But to me, we've done great things on the plan design side, and including some of those things like the statement, like I talked about. But I think the next sort of wave of innovation is going to be on the investment side, right? And DBizing DC plans.
Yeah. Now, I know we're coming up on the close of this panel, so I'm gonna go around to both of you and just sort of get your key takeaways as we come to an end. What do you want the audience? What do you hope the audience really heard from this panel? What do you want them to take from this? So I'm going to start with you, Michael.
Well, I'm going to reconnect with how I started off. Right, the DC market is obviously in a fluid space right now, and it's going to continue to change. And I think, when you look at what the challenges are for participants in DC plans and the plan sponsors that offer them investment choices, think about it. We're now in an inflationary environment. There's going to be increasingly a need for income alternatives. We've talked about the lower volatility. We've talked about having at least some alpha or target-oriented returns, and private real estate makes sense to be included in the solution set here. But it's not it can't be just some real estate managers trying to figure out what that solution is isolated, and it can't be plan sponsors also being isolated. We need to actually come together, and which is what we've been trying to do, a number of us on this panel in the industry, is to constantly develop new solutions to meet these evolving needs. And some of it is going to be just the very nature of the world today, where many retirees are actually staying in their company plans. Back in the day, they used to be pushed out. They'd have to go through and enroll to an IRA and deal with having the forest of figuring out, what am I going to do? We're providing them opportunity to glide themselves into retirement with a diversified portfolio and with income solutions. And private real estate has a role there. So it's going to just take us working together to make the right strategies to meet those goals.
And Trip, what are your key takeaways?
Yeah, I mean, to Michael's point, I think, DC plans now are the primary retirement savings vehicle for most Americans. And that has a couple of implications, right? To Michael's point, it's not only accumulation, but decumulation. And real estate is just such a great solution on both sides, right? So on the accumulation side, lower volatility, diversification, and on the decumulation side, income and inflation protection. So I think we're going to see plan sponsors and their consultants be more innovative on the investment side. And I think plan sponsors are going to need to differentiate their DC plan, to attract, great employees. I mean, we're seeing a super tight labor market right now, the great resignation, right? I mean, folks are looking to companies like, okay, what do you got for me? Can I work at home? How much vacation do I have? What are the benefits? And oh, by the way, what's the retirement plan look like, right? So I think, instead of, kind of the old days where plan sponsors would say, hey, I'm just going to go right down the middle, I'm going to play it safe. I'm going to hit my 7-iron from, 200 yards away and then wedge in, stay on the green and pick all passive. I think today plan sponsors need to differentiate a little bit, right? And we've talked, our panel and the previous panel have talked about ways to do that, and I think private assets and private real estate are a great way to do that. At the end of the day, it's about enhancing, the outcomes for participants, right? And creating outcome-oriented investment products. And I think the industry is sort of shifting, kind of the mindset to outcome-oriented versus just, solutions building. By outcomes, I mean, okay, on the accumulation side, it's, accumulating assets with lower volatility. On the decumulation side, it's income, right? So I think there's going to be a lot more innovation over the next few years. I think COVID kind of put a little bit of a bump in that, but I think we're sort of going to accelerate into it in the next 2 to 3 years.
Well, I want to thank Trip and Michael for joining us. One thing I really appreciate in this conversation that we've had so far today, and hopefully we can continue it after the break, is how important this is, and that we're talking about real people. These are people's retirement accounts. This is trying to come up with a way for someone to retire and have that retirement and have that security and that safety and that ability to have that, sort of American dream future. And so I really appreciate how much this has focused on participant outcomes and what kind of a future we are building for retirees. So I want to thank Michael. Thank you, Michael. Thank you, Trip. I just want to mention we're going to take a 10-minute break. We will be back at 50 minutes after the hour for our final panel, where we will really talk about the implementation and some case studies. Thank you.
Thank you, Loretta.